Hi, my name's Joshua Mahony, Chief Market Analyst at Scope Markets. Let's take a look ahead to the upcoming UK inflation report due out before the market open on Wednesday, the 14th of February. In terms of what markets are looking out for, we have a upside move expected for headline inflation and a tick lower in terms of the core reading. But if you look at some of the underlying metrics, what's interesting here is that we're expecting to see a potential negative reading across both month-on-month inflation, month-on-month core inflation. But, and as we'll look into it, some of the base effects are really what's driving those moves in terms of the year-on-year figures. So really, we need to look at the underlying figures to understand exactly whether we should pay attention to those big year-on-year numbers or not. I think by and large, markets are likely to be underwhelmed if we see inflation remain steady or move higher. And that could give us a short-term move. But from a wider perspective, that may not necessarily tell the full story. Here is the outlook for headline inflation. Currently at 4%, markets expecting a tick higher to 4.1%. Of course, still double that 2% target from the Bank of England. In terms of the second section of this chart, this is where it's particularly important. What we're seeing this time around is last January's figure of minus 0.56 drop out. And so what we're expecting this time around in terms of the potential for another negative reading, well, on any other month, that would be a particularly good thing. If we saw a negative reading last time around, that would be brilliant because we're switching out a positive reading from last December and replacing it with negative month-on-month reading this time around. But it's because of those base effects that even if we saw a negative reading for this January, we could still see that year-on-year figure tick higher. And the reason why we can largely discount this is the fact that if you look in terms of the forthcoming months, those readings for February, March, and April are really hefty. And if we continue to see significant disinflation on a month-on-month basis, come February, March, and April, when those drop out, that is really likely to see significant disinflation kick in for the UK. So we're at this sort of calm before the storm, essentially, where it doesn't look great. It looks like the UK inflation picture is way above target and that we might have to hold on for a long time yet for the likes of the Bank of England to drive down CPI to target. But if you look at these month-on-month metrics, you'll notice that the 4 months beyond this meeting or this reading are going to do all the heavy lifting and likely get us back down towards target. And that's exactly what we can see in the third section at the bottom end of this chart. If you look at the annualized figures, so the last 6 months, 7 months, and 8 months, how would that look if we annualized that out across the entire year? Essentially, all of it takes us to 2% or below. So over the last, say, 6, 7, 8 months, we're tracking at target or below target, and the Bank of England are going to have to switch towards a more dovish outlook and a dovish stance in the near future, despite the fact that by and large this time around it looks likely that we're not necessarily going to see something that would encourage you to think that we're going to see any sort of dovish pivot from the Bank of England anytime soon. So headline CPI expected to move up to 4.1. I think there's a good chance we see it rise even further than that. But look beyond that and look at the month-to-month metrics. The coming 4 months are going to see dramatic disinflation here in terms of headline inflation for the UK. In terms of the core metrics, it's a similar kind of story. We've got this big negative reading drop out from last January, and therefore the ability to see any sort of downside for the core CPI reading is limited. We have also got these big chunky prints for February, March, April, and May that will drop out. So again, we're likely to see significant disinflation. We're coming from a higher level, 5.1% here in terms of core CPI. And if you look at the annualized figures, despite the fact that we do see these significant numbers drop out in the coming months, those annualized readings do show that whilst we are going to see significant disinflation, and we are likely to see significant disinflation in the coming months, we are still going to struggle to get that back down to that 2% target. Instead, more likely to move from 5.1 as we are at the moment, more towards the 3% bound. But if we see headline inflation essentially on track to move back down towards 2% and 1%, and then the core reading looking like it's going to head to 3%, think there's a good chance that we see the basis for the Bank of England to take on a more dovish stance. And certainly the outlook from the likes of the Bank of England, or the outlook for interest rates from the Bank of England, likely to shift in response. In terms of a couple of the markets that we could trade around this, first and foremost, this is the FTSE 100. In terms of the wider picture, we can see that by and large, this market has been trading essentially within a sort of range, really. You can see price action has just been stuck between the sort of 7,200 up to 7,700. And that zone has really held for the last 6 months, probably longer. We've looked recently like we could start rolling over once again, because as we can see here, we've got this sort of double top formation. Let me just get rid of this so we're not staring at purple constantly. There we go. So we've got this sort of double top formation. You can see it here on the hourly time frame. So we've rallied up into this area of resistance and started to roll over, rebounding a little bit in the lead up to this. But if you look at what this inflation metric is going to tell us, this inflation reading is going to tell us inflation remains a problem. It remains elevated. We're possibly going to see headline inflation move higher. Core inflation is highly unlikely to see any sort of decent downside move. And so for someone just staring at those big figures, there's the possibility of a risk-off move coming into play for the FTSE 100. So whilst we're seeing a little bit of upside in the early part of this week, I think there's a good chance that we do see a risk-off move around this inflation gauge. But the wider picture shouldn't necessarily provide that same basis of bearish sentiment, because I think soon enough we do see inflation coming off in a meaningful manner. So it looks like we could have topped out for the near term. I think there's a good chance that we do see that continue a pace following this inflation gauge. But you need to be able to look beyond it, because even if we do see that near-term disinflation, that near-term downside move for the FTSE 100, the wider, longer-term disinflation picture is relatively positive for equities and for the FTSE 100. In terms of the pound, we've seen the likes of the euro really sort of consolidating of late, rallying back up into this descending trend line that we've got here. This comes off the back of a period of downside. Now, ultimately, we do have the picture of Eurozone inflation likely heading towards target soon in a similar manner to the UK, but the economic picture is weaker than the UK. Bear in mind, the UK does have a whole series of interesting data points coming out over the course of the week, the likes of the GDP figure on Thursday, retail sales on Friday, the jobs report on Tuesday, and of course on Wednesday, this inflation report. So plenty to sink your teeth into. We've also got the GDP figure coming out from the Eurozone. But I do think there's a good chance that we do see this sell off if we come out with a strong CPI number, which I think is likely. But like I said, from a wider perspective, there is the grounds for this disinflation move to come into play for the pound. So any near-term downside could come back into this sort of zone of support. But bear in mind, the wider picture points towards significant sort of uptick in disinflation for the UK, which is negative for the pound. So that could actually be supportive for the likes of euro sterling to potentially reverse some of these downsides. So around this report, I think there's a good chance we do see a sell-off back into the support zone. But over time, there's a good chance that we start to see a little bit more of a bullish turnaround once we start to see that disinflation kicking in the UK. The wage figure is going to be really interesting as well, because we need to see UK wages driven downwards to really gain a greater handle on whether the Bank of England is going to feel comfortable cutting rates. If we're seeing core and headline inflation moving towards 3%, 2%, but wages are at 7%, that's still a problem, and that's going to be a concern for the Bank of England. So as long as we see that wage figure move lower, which is expected, and we see inflation down the line looking like we're going to head back in the direction of that 2% target, then I think there's a good chance that we do see the pound start to weaken. We haven't got into that position quite yet, and this report does provide the basis for a potential move against that, with potential strength for the pound, given the outlook for the likes of the Eurozone. I think that could see us move back into this support zone. But like I said, the wider picture should be dominated by the fact that you understand that the disinflation doesn't kick in now. This is the calm before the storm. And then in a month's time, we're likely to really start to see that disinflation story come back into play. And that's when we could see, or in the lead up to that announcement, we could start to see the pound start to come under pressure.